Welcome to Zen and the Art of Real Estate Investing. What if you could learn from experienced real estate investors, find out what got them to where they are now, get insight into their daily habits, and take these insights to inspire your own growth? Each week, Jonathan Green shares an in-depth look at the mindful approach to real estate investing. Jonathan is a lifelong real estate investor, advisor, and coach, as well as the founder and team leader of Streamlined Properties. Whether you're looking to start from scratch, get to the next level, or just for a straightforward and honest approach to real estate investing, Jonathan seeks to provide a free mentorship program you can take with you anywhere. Now, here's Jonathan.
Welcome back to another episode of Zen and the Art of Real Estate Investing. This episode, my guest is Sam Morris of Sunset Capital. They're talking real estate investing, syndications, and storage and multifamily because they provide stable income streams, diversification, appreciation potential, and the tax benefits. We're going to get all into it next with Sam. Let's go. This is episode 214 of Zen and the Art of Real Estate Investing with my guest, Sam Morris. Sam has 18 years as a corporate banker, more than 20 years in real estate acquisition and disposition. He's the CEO of Sunset Capital, a Houston-based vertically integrated real estate investment and asset management firm. Sam, welcome to the show.
Hey, Jonathan, thanks so much for having me on, bud.
Yeah. Happy to talk to you. And there's something interesting that you sent me in the pre-form that I want to start off with, and it's about cycles. How important is it for people to know those of us like us who've been around for the cycles in real estate?
Yeah, it's funny, having a few gray hairs on you really seems to be beneficial in markets like this, right?
Well, it makes us distinguished as well.
Yeah, exactly. So, yeah. Well, and frankly, having a few battle scars too, right? Yeah. Having gone through some ups and downs and being able to notice what's in front of you and the best ways to react or the best ways to pivot or adjust going forward. Yeah, that's actually a very, it's not something that we've been talking a lot about, but it absolutely is something that's prevalent in the market today.
Yeah, and it really is something that should be coming up for newer investors because we're in this kind of odd cycle that nobody expected where it's not really going the way that we thought. And that's why I think, people like us who've been through it, we know, okay, real estate traditionally, if you can just hang on, you'll be okay. But newer people may not know that that's part of the plan.
Yeah, it seems like, it's obviously where you're located and things like that. But there's a flatness that we've kind of had the last, call it, 15, 18 months, something like that. But it's also very different than, say 2008 and 9, right? Where that was truly a financial crisis. Yeah. And I would say that the ability to borrow money, the ability to actually work things out was far worse than it was. I mean, you were really put into a dogfight. Yeah. And it was operator versus operator at that point, just who can out operate the person next to him because somebody was going to fail.
Yeah. And I think it is a completely different time. I think the national news likes to place these doom and gloom things on it to make them the same, but it's totally different. We're talking about a very big recession to now where they still try to call it a recession, but still home prices are going up.
Yeah. Well, and you still have affordability issues and things like that, but it's not the same of what we had back in 08 and 09. That was truly, terrifying. This is something you can absolutely pivot and operate out of, and you can work with vendors and lenders and all kinds of things. And there's a lot more options that are available to you if you're struggling.
Yeah. Well, in regard to the 2008, 2009, were you in banking at the time or were you still? Yeah. So what was that like? Because especially for Texas and Florida, those markets got hit pretty, I guess, bad just because there was a lot of big operators in there at the time. Yeah. How was that for you?
Yeah, ironically enough, I had actually switched institutions at that time, and we were a de novo, which means we started from zero.
Yeah,
which means we didn't have a lot of the bad assets on the books, and so we looked great. I mean, we pat ourselves on the back all we wanted, but timing was a great thing for us at that point. We had capital to lend as well, so we were really in a unique position at that time. But what I will say is there were absolutely, just because from being in the industry, there were several my cohorts in the industry that were putting people out of business.
Yeah.
And it's a tough world when that's what you're you're designated to do, is to take assets back and things of that nature. And it's a whole nother world when you're working with non-performing assets, and you speak differently to the borrowers at that point, and they speak differently to you. So, that communication style was something that was absolutely, having gone through and learned and understood, how it had to work. It's not unlike some of the things that have to happen today, right? The way that we communicate with lenders is actually of critical importance, and being able to understand that vocabulary and know what's needed to be said and when it needs to be said is actually a competitive advantage we have.
Yeah, it must help you so much now being in the acquisitions and disposition for Sunset to have that banking background, because then you're going to be way ahead of the curve on due diligence. And you also, as you were just saying, you speak the lender language.
Yeah, they have a different vocabulary, right? In the real estate world, we have acronyms. We have a different vocabulary, but
there's an acronym for literally everything. I don't know that they all make sense.
Yeah, but they have their own way of speaking in a different language too, right? And being able to speak both of those languages and marry that up to where there's a great and clear understanding, yeah, it absolutely helps us at Sunset Capital.
Yeah, well, let's take a quick trip back to your beginning. When you were growing up, did you think about real estate as something that you thought you would get into?
Yeah, it's so funny you say that. I was never, it was never really introduced to me that way. In college, I really got my first taste of it, right? So I would tell you more from the theory aspect of it. So my degrees are in banking and finance and in business management. So I always thought I would go become an investment banker.
Yeah.
And long and behold, I became a community banker right out of college. But one of the things that taught me too, because I started at the bottom, right? And so all I was doing all day, every day was underwriting deals.
Yeah.
Literally for years, all I did was underwrite deals. And so, I always chuckle because they say, if you, you master a skill, if you do 10,000 hours on it.
Yeah,
so
tipping point.
I was a master underwriter probably before I was 25. Right? Because I'd underwritten so many deals.
Yeah. What type of deals were you underwriting just when you started? Was it small multifamily, single families, or were you into large scale assets at that time?
It was everything too. So I would tell you it was, it wasn't just real estate. It would have been operating entities. And so I had a very well balanced, mix of everything that I was looking at. I understood businesses. I understood real estate. And so, and really from the quantitative side, and then understanding some of the macro side of what it took to actually lend money to those entities, right?
Yeah.
So you learn a lot at that young age. And so the great aspect of that was I started figuring out, man, these guys are making a lot of money doing these things. And so in my 20s, I go, I'm going to participate in some of this. I knew who a lot of the operators were. And so I started as a passive investor. Like many of the investors that we have, I started that way.
Yeah.
But I had a different view of looking at it. I had a great understanding of interest rates. I had a great understanding of the things that could impact the actual real estate itself. And I knew how to underwrite them, better than a lot of those operators too, because I knew what lenders would look for and I knew what investors were expecting. And so, I started in my 20s investing into these deals. And then I started raising money for them back in, call it 2012, doing the asset management side of it.
Yeah.
Really having a great understanding of the operations and how things worked. And then from there, when we sold our last bank institution in 2018, I went into it full time.
Yeah, what a great foundation. And it's a common thread across people who've been involved in banking, mortgages, and even as attorneys, because as you were saying, as a young person, you start to see all these deals come through that you're participating in, and you're like, well, these guys are crushing it. Like, can I get some of that pie? But you actually did take a chance and go into that starting as a passive investor. And I've been saying a lot that I think that's the way a lot of high earners are going to go now, as home ownership is generally too expensive for a lot of people or unnecessary. What do you think about that?
Look, the barriers to entry were huge to me at that time. Being in your 20s, I was starting a family, and I had to come up with I think $50,000 to put into our first deal. Man, and it was a trial by fire type thing. But it was, hey, look, this is going to be something that I think could absolutely work because I understand the deal, I understand what we're doing. And you talk about education. I think we did that deal in 2007. The next month after we closed on that deal, we had a hurricane come through and just blow up the property. And so I learned everything about insurance really quick too after that. Because, in my mind, I'm like, oh my gosh, did I just lose all of our money that I just put into this deal? everything's been an education and learning more and more about it. And, I've done a lot of things right, but I've also done some things wrong and had to learn from it. So.
Yeah, that goes to the battle scars that you talked about in the beginning, and maybe a couple of both of our gray hairs, but it's part of the process. And I think that, there's kind of this rhetoric out there that, forcing people to take action, but part of it is true. Like, you do need to get in the game and you need to understand the risks. Because of your background at the time, you kind of had, educated risk as opposed to people who are hopping in and just hoping for the best.
Sure. Yeah. The bulk and I would even say today, still the bulk of what we do is risk mitigation.
Yeah.
Right? We're figuring out ways to get the highest return possible with the least amount of risk associated with those dollars. And so, look, that's no surprise, right? And that means asset classes. That means the way you operate. It means the way you buy it, the way you finance it. There are a lot of things where additional risk can come into play for you to be able to do the deal. And all of that needs to be at least identified and then mitigated, and or it has to come into play for the returns, the expectations of the returns associated with the risk.
Yeah, I love the terminology risk mitigation because it just shows that everything has risk in real estate. I believe it's a very stable asset, but that doesn't mean that there's no risk involved. Generally, if you buy something and hang on to it a long time, you're going to make money, but a lot of things can happen, natural disasters, fires, errors in due diligence. So it is assessing that risk. And I think that's what people need to learn about. And that goes to the tipping point, those 10,000 hours that you talked about, because I feel that a lot of new investors, they're not getting enough reps. And it does make it easier if they can start with passive, because then they're reliant, but then they need more reps talking to operators so they know what's going on. Do you agree
Absolutely.
with that?
Oh, for sure. And, I always say, good or bad, the way you like it. I've been through hurricanes. I've been through floods. I've been through fires. I've been through all these kinds of things that have occurred on properties. And man, as terrible as it is to go through some of this stuff, and as terrible as impactful as it is to the people that rely on your real estate, having actually already gone through that, it really helps for the next time something happens and it's not as big of a deal to you, right? So,
yeah,
it's one of those things where, I've earned these gray hairs like we talk about, right? And having already gone through that, it allows for some reassurance to our investors to go, look, if another hurricane comes through, one, we already know the risk mitigation that we're going to do at the property level, the things we're going to do to, bat the hatches down and make sure that we're going to be as prepared as possible. But secondly, if something does occur, we already know the steps and the people we're going to be bringing in and things we're going to do to help, limit the damage associated with it.
Yeah, and that those cycles go to now the assessment of what insurance costs, because obviously in a lot of areas it's gone up. Those of us who've been in it are like, well, I mean, I can't really control that. It's the cost of doing business. So that just becomes now a part of our due diligence. And does it make sense? And if there is another big incident, we're covered. I mean, that's what insurance is for.
You can do. I mean, using insurance as an example, right? It's, there are things you can do to the property before an event occurs, right? Yeah. There are maintenance logs that you can do where you can actually show the ongoing maintenance that you're doing to provide to your insurance company that can absolutely help with your premiums. There are ongoing things that you can do as an operator to make sure that you're getting the best deal possible, including talking to many different insurance groups that are out there, right? Yeah. And making sure you have the best available, product for the investors so that they can get the best return associated with it.
Do you feel like with the insurance rates going up so much that some large scale operators might be a little bit underinsured because they're trying to make the costs look better for that overall package?
That's possible, but what we're seeing is a lot of them are they're going to these master policies too, where they're trying to just spread that risk over the large group, right? They're doing that just so that they can limit the risk associated with some of their, say, tier one assets, like coastal or something of that nature. And then there's groups that allow you to piggyback onto their policies that way. And the third party property management world is notorious for that. But I will also say this too. We've been told, hey, we're not underwriting any tier one assets. I'm in Houston, Texas. So Harris County is a tier one county, right? And so, we're very vigilant and we're very aware of what can happen and then what you need to do. And so there's going to be some kind of tipping point because the costs have actually gone up just dramatically. I mean, over the last few years, I would say you're at least double, if not triple. And that's a pretty large, uncontrollable line item that a lot of operators are having to deal with.
Yeah, I mean, especially in the syndication and fund space, you look at it and you had a projection, on a 10-year plan, and then 3 years in, you have a cost that doubles or triples.
Yeah,
You have to figure out what to
shot.
do.
Yeah, your pro forma is shot at that point. It is not going to be what you were originally thinking.
Yeah, and if you take that and then go with what some people are using with bridge loans or floating rate, and you have these two things that are both increasing, that's caused a lot of the problems that have happened, I guess, over the last couple of years, right?
Absolutely, yeah. And when you look at things where you're adjusting your pro forma, you've seen top line growth too over the last several years, and maybe a little bit more stagnant in the last year and a half or so. And there's a lot of projections of what that's going to look like from a supply demand imbalance. But I would tell you, that's kind of been the constant battle is how do I get this closer to my pro forma, and or are we going to have to readjust expectations to the investors? And then how transparent are you being with your investors about that? Yeah. And then what are those steps you're going to be doing to help, enhance where you're currently at or what you currently have? And so we've seen certainly a lot of guys will go from, say a 1 or 2% name storm deductible to 5%. Well, I mean, if you're going to do that, do you have the reserves to write a fairly large check in the event of something coming through and hitting that way? And have you taken the steps to protect the investors from that?
Yeah, that goes to, partly the skin in the game and people's due diligence on the operators and what kind of operators they are, what their experience level is. Because I think now for me as an LP, I always want the transparency. And I hadn't invested in syndications until last year after 30 years in real estate. And I'm kind of a little bit obsessed because why didn't I do this like you when I was younger? This just seems like a better option. But you can go wrong with the wrong operator. And there's a lot of inexperienced operators in the field now.
For sure. And so that's why, going back to the aforementioned, the gray hairs and the battle scars, I mean, it absolutely makes a difference with who you're investing with. I mean, I've told people you back the jockey, not the horse.
Yeah. Yeah. Somebody else said that recently, and I can really see it because you're like, oh, well, they've ridden all sorts of different horses, through different tracks and everything, which is, a market cycle and understanding that, okay, it's not, we're going to collapse everything. It's how are we going to figure out what to do and how are we going to explain this the right way and be transparent so that we can maintain those same investors over time. Because the second that you're not transparent in real estate, you're going to lose business. It's just a matter of how much.
For sure. Yeah. And it's how much more you're going to have to communicate to, or really over communicate to get everybody comfortable.
Yeah, whenever someone's like, well, maybe we shouldn't say it till later, I think of every romantic comedy movie out there where it's something little happens in the beginning and they're like, oh, I won't say anything. And then, of course, it becomes a big issue. And you could have just said something. It's better to just get out of the head of the curve once you understand what you're going to do as an operator. So when you got started into this space, have you always been just multifamily, or did you play around with other assets as well?
I played around with a few other assets. Really, we're in two verticals. So we're in multifamily and storage.
Oh, nice.
And I would tell you outside of that, we probably have a little bit of knowledge gap, at least from a corporate level. And so we really just stay in our lanes just because, we know what we do and we do what we do well. So it's the same thing with markets too. We predominantly stay in the state of Texas. If we were to go outside of the state of Texas, we would have knowledge gap, and we would probably have to be a co-GP into something with somebody that has boots on the ground and the local knowledge of that immediate area.
Yeah.
That's, again, when we talk about mitigating risk, I mean, you're taking on additional risk when you go outside of, areas that or you go outside of asset classes that really well. And so, we stick to what we know really well.
Yeah. Do you do one like syndications, or do you also have funds?
No, we do everything is syndication. So we're still deal by deal on everything we do. Now we will take down portfolios,
right? But
it's still a single syndication when we do it.
Yeah, and that's an important distinction we've made over several of the last episodes because it for me, I personally enjoy as an LP syndications because I feel like I'm really a participant in an asset. I know from an operator standpoint, those who run funds, it's a little bit more freeing when you're in a fund because you can just do what you want. But for me, I've been in real estate, so I want to be a part of the asset. I just don't want to have to do anything. It's great.
Well, for sure. Yeah. Oh, yeah. Being passive still, I mean, I would tell you, is still the ultimate goal for a lot of people, right? Because look, I mean, if you don't have to do the work and this is all I do all day, every day, right?
Right.
If I was able to still get paid on all the assets that we have and not have to do anything, yeah, that sounds fantastic, right? But then, for me, what would I do with my time kind of thing? And I still really enjoy what we're doing every day. And so, but there's a lot of things that I get to do every day that makes each day a little different, right? So, I could be, this week I'll be touring another asset. We'll be, doing investor relations things. I get to do podcasts with guys like you. And so every day is a little bit different. And so each week offers something a little unique for me. And I plan on continuing to do this for forever at this point.
Yeah. I don't ever want to retire. I don't really get the retire early philosophy. Again, I've been talking about that. I just like real estate. So why would I stop? I mean, I'm on time freedom. So I just going to do whatever I want to do anyway. I enjoy it. It's fun.
Yeah, that's great.
So when you're comparing multifamily and storage, just for people out there who might be looking to get in as limited partners, what's the avatar? I mean, someone who wants to get into a storage syndication or someone who wants to get into a multifamily. Personally, I'm interested in both. I'm only invested right now in multifamily, but I love self-storage. What's the difference between those avatars in your opinion?
Yeah, as far as the type of investor, I would say you'd have to actually look at the type of assets, right? Because I would say for the most part, storage is like an extremely stable, more of a cash flow type of asset. You're going to get probably less on the back end, but you'll get paid more along the way.
Yeah.
Multifamily, depending on how you buy and where it's at, the cash flow may be slightly less, but you can have a bigger exit as far as your overall return. But the thing is, the overall returns are somewhat similar the way you look at it. The way they operate is very different. Right. And so, and the simplest way I can say that is, on a multifamily site, you have a lot of people.
Yeah.
On a storage site, you don't.
Stuff.
Right?
Yeah.
Well, I mean, there's stuff, right? But at the same time, too, like, at least in the state of Texas, the way the landlord laws work, if you don't pay me in the state of Texas as a landlord at a multifamily, all right, there's very specific steps I have to take and timeframes I have to take it to get you removed from that property, right? And so it'll take a certain amount of time. It's going to cost a certain amount of money, right. And we have obviously a lot of steps, and it all has to be documented that way. In storage, I can just throw another lock on your unit.
Change the code. I know.
Right?
Yeah, right. Old school is swap out the lock. New school is change the code. You can't even get into the building.
Yeah, and so it's just different the way that they operate. And so another saying we say is, real estate's easy. People are difficult.
Yeah.
And I think way to say that.
Yeah, your value add just on pricing is so much different because when you do. Not talking about value add in terms of renovation. I'm just talking about operationally. When you go to raise rents in a multifamily, you really have to look at all of the data everywhere, understand what it is. Are these people willing to go up? And then you still have to talk to the people and say, hey, we're raising your rent. In self-storage, you can basically just bump it up $10, a few times a year. And no one is, I know this from being the person who hates it. Like, they went up $10 again. But am I really going to go move my entire storage unit for $10 a month? And you can keep doing it. That's storage. I mean, and if you add more amenities, it becomes worth it.
Yeah. So in storage, we call it ECRI, which is existing customer rental increase.
Yeah.
And it is a major metric that is looked, right from the big REITs right down to the little operators.
Yeah.
It's a game that everybody's been playing, in particular the last 24 months. Because of, just stresses on occupancy. But it's like what you said, it's that convenience factor. If somebody goes up $10 and you have a 10 by 30, you have 300 square feet of stuff.
It's like really $1,000 to move it. I mean,
are you really going to sit there and bark over $10 a month, right? But, the metrics will show, we're going to have a small attrition, but whatever it is, we know how sticky those customers are. And I would say the data in storage is starting to catch up to that of multifamily, right? From a technology standpoint and things of that nature, multifamily was definitely ahead of storage.
Yeah.
And I would say, it used to be by a lot. And I would say with the REITs that have come and really taken a large portion of the market up, that has slowly started to change. And I would say storage is quickly catching up to multifamily as far as technology goes, as far as level of sophistication.
Yeah.
And the data that's out there and available. It's pretty significant.
Yeah, I mean, you talked about attrition, and if I look at both storage and multifamily, there's kind of this positive attrition when you take over a property because you're trying to get out the worst tenants for either the ones that don't pay or causing a problem. So when you across the board make the increase, there's always a subgroup where you're like, I really hope they leave.
Yeah,
Just because they're a problem, you just want to try to eliminate the problem tenants.
Yeah, it's the large difference between physical occupancy and economic occupancy.
Yeah, yeah.
Because what we care about is who's actually paying us.
Yeah. Hey, it's Jonathan. I hope you're enjoying this episode with Sam Morris as we talk multifamily storage and syndications. Hey, but if you have large-scale assets of your own or just investment properties, you might be interested in cost segregation. So take a second to write this down. My friend Sean Graham, who's been a guest on the podcast, will give you 10% discount if you sign up with my link, mavencostseg.com/green, and green has an E at the end. He's done it for several clients of mine and friends, and he's there to help you. Let's get back to Sam. What's the percentage breakdown between multifamily and storage for you guys?
As far as what we currently have from an assets under management. So we have about 1,300 units on the multifamily side currently, and we're a little over 2,000 units on the storage side. I always tell people, because they'll say, oh, that's great, you got all this stuff. And I said, yeah, but everything's for sale, right? I mean,
that's what I say.
I'm sold out tomorrow. I could be zero tomorrow if somebody gives us the right number on everything. And so,
that's a really good point, though, because I've a lot of newer investors that they get their first 2 or 3 doors and they're so emotionally attached to them. I grew up with a dad who was an investor. I'm like emotionally attached to absolutely nothing except my children. And like real estate, the funniest thing is like when you're doing off-market acquisition and someone tells you, no, I don't have a price. You have a price. Everybody has a price. I will pick up and leave my house in one day if you give me an amount that makes sense. I don't care.
But at the same time, too, I tell people I'm married to my wife. That's it. Everything else is for. We will sell everything. Right.
Same as what I said. My kids, and then real estate. Don't care. Just make me an offer. And I think, look, that's why hedge funds are successful. They have the money to buy whatever they want. But part of what people are doing for some in multifamily and in storage, depending on what your particular exit plan is, they're getting them running operationally significant so that they can be offloaded to these larger companies who want to turn it into something. They don't need to do anything. They're just buying a top performing asset. Is that who your end buyer is for these?
It depends on the asset that we're going into, but I would tell you the way we do our underwriting is we'll go into the deal. We will actually recognize who the potential buyers will be when we're trading out.
Yeah.
And one of the things, and it sounds so silly because it sounds so obvious, but it rarely happens. Once we win a deal and we close, one of our standard operating procedures is go back to the broker and say, tell me who was also bidding on this. You don't have to tell me the amounts. Just tell me who actually made offers into it, because there's a great likelihood that those are your trading partners years from now.
Yeah, that's a great idea.
Well, and it's so simple, right? And then you realize how many people do not do that, right? And the broker has nothing to, there's no hidden fact to tell you here's who bid on it, right? You don't have to tell me the amounts, just tell me who bid on it, right? Whatever it was, because those are your potential exit partners X amount of years from now, if they're still in the game looking for those types of assets, right?
But it's so smart in the beginning while you're buying to know who your potential end buyer may be. I mean, that's business buying 101. What's your exit plan? Like if you don't have an exit plan, you're not going anywhere. You don't know what you're going to do. And really important for a multifamily, that's really dependent on the amount of units, because those big companies, hedge funds, they're not buying really under 250. So if you're under 250, you're probably selling to someone different. So the way that you're going to create it operationally might be a little bit different than you would on the larger scale.
Yeah, and who are those regional players, right? I would tell you too, strategies are actually really important. And from an investor standpoint, knowing what that exit strategy is, I would say is of critical importance. He's a friend of mine who's also a syndicator, and they're growing their company just dramatically. But part of how they plan on exiting is effectively resetting the market with the assets that they're buying and putting so much money into these assets that they're buying. And, to sell at a later date, their plan is to sell at something that that price has never been achieved in the submarket. That's sometimes tough. And I'm not saying they couldn't do it. It's sometimes tough from an investor to sit there and go, I'm going to buy this now. These are the things we're going to do to it. And then we're going to have to sell it higher than it is, higher than anything in this submarket is ever sold for, to be able to achieve the returns associated with what's being presented. And for us, that's kind of a hard pill to swallow, right? Because there's so many different market cycles. And it very well could be, as time goes on, things sell for more. You should, in theory, get records every couple of years. Yeah. But if that's how you're planning it too, and particularly in that value add strategy where they're at, that's really tough because new product constantly comes on.
Especially in Texas.
you're battling a lot of different things, right? You have to know, man, this could be hard to achieve.
Yeah.
So it's just little things like that, and understanding the exit strategy, I would say for most investors should be of critical importance, because really that's how, in the multifamily side, you're going to really get repaid. That's how the bulk of your funds are going to get repaid to you.
Yeah, and that goes back to something that we were talking about before, you only investing in Texas. When you're geographically clustered, you don't have to go for that home run out value, because if you're trading similar products and then you have an out on one and it's very good, it has a trickle down effect on your other similar products and raises their value. It's like buying 5 single family homes in the same area, rehabbing all of them, keeping 3 as rentals and selling 2. You just create your own comps. This is part of a strategy of being local and geographically clustered, right?
In addition to that, though, you have some operational, enhancements too, because you can do things like staff share. There's some costs you can spread over a larger pool versus just that one.
Yeah, that makes a lot of sense too. And that goes to the vertical integration too, because when you're vertically integrated and you're doing management and you have 3 or 4 in a geographically achievable area, as you're saying, your costs are going to be a lot less than somebody who, is doing one in Florida, one in Wisconsin, and doing one here.
Absolutely. Absolutely, it would be.
Yeah. Vertical integration is something that I find to be so important, and it's becoming more and more on, I guess, a lot of people's radars. Did you start that way at Sunset Capital as vertically integrated?
Well, so we're owners and we're asset managers, and a lot of times what we do is we partner with our property management group.
Yeah.
And sometimes that's a large group, sometimes it's a smaller group, right? But what we're doing is we're integrating them into it, and we're making it to where obviously they get, they have the benefit of making sure a lot of attention goes to our property. They have the benefit of when it sells, that's going to be really their carrot at the end as well. And so it's just been the way that we've decided to structure it. I've done the property management side. I was at another institution where we did thousands of units here in Houston, and we had full property management, asset management, and property management is tough. It's probably the easiest way to say that.
It's not, I think people don't realize it's not, you don't really make money in property management. The people who do it as vertically integrated, doing their complete own management, know that they're not making money on that. They're just providing a service to relay the overall fee. And you can do that as part of, shares with the property management company and things like that.
Correct. And so, property management, it's really tough to make
low
money
margins.
In property management. Yeah. You have to be running it at a scale that's so large to really make money off of it. And I would say it's really tough, right? Because of just, how competitive the markets are. It does give you, I would say it does give you more control, which is why we like to partner with them, because then we can make decisions like that, right? So, if we're discussing, we meet every week with our asset management and property management groups, and we talk, performance and where we're at. And so in addition, we get daily updates. So I know, vacancies and occupancy and, where leads are generated, things like that every day. So it's one of the things we look at because we do our trend analysis from that. And what's interesting is if something isn't working, it can get changed that day. It becomes, boom, you're in that day, and staying nimble and agile that way and having that partnership with them really helps, from an overall asset protection and asset value.
Yeah, and I think it's important for the listeners to know that the margins are slim on property management, because a lot of investors will go out and they're going to say, hey, well, I'm just going to pick up a BRRRR in, Louisiana and another one in Arkansas. And they don't realize that getting property management for your out-of-state investments, when you just have one property in an area, you're like the bottom of the totem pole, and all of the major property management companies don't want to do business with you. So you're left with a subset of bad ones and new ones when you just have a 1 or 2 units. And that's why a lot of people start with single family and then they're like, well, this is too slow. Let me get into multifamily because I can get 8 units under one roof, which is more attractive to a property management company.
For sure. But I would also tell you that was a lesson I learned early on too, is to go bigger, faster. Yeah. And the reason being, and when I say bigger, I mean size and scale of property, right? So I've never even looked at anything that was less than 100 units. And the reason being is I needed enough income to pay the staff to be able to run it. Yeah. Right. And so when you get down to, even the 1s, 2s, or 8s, right, it's really hard to afford the quality staff that you're going to need to be able to run that.
Yeah.
And therefore, having something a little bit larger provides you the income to be able to run the property in the manner that your business plan suggests you're going to.
Yeah. Yeah, it makes sense. I mean, there's just a lot of misnomers about how property management works, but spreading yourself out in several different markets for smaller units just isn't cost effective. It's just...
I mean, if that's what you want your full-time job to be and all you're doing is running around to all these properties, I wouldn't say that's the most efficient use of your time, but there are people that's what they like to do.
Yeah. And I think, look, if self-management, it's not that hard. I really don't think it's that hard, but there's a certain amount of units versus the time that you have available and what you're willing to do that will make it hard.
Yeah. And so for us, to create scale and to create opportunities needed for our investors, we typically need to be in a larger facility. I would say that 100 units would probably be by far the smallest we'd want to do. And like what you were talking about for trading out from an exit strategy, if you want to go to the bigger institutions and sell to them, 250 units is kind of their baseline minimum.
Bare minimum.
Yeah. And part of it is they're looking for a certain level of income that comes in every single month to help facilitate their cost for them doing the management associated with it.
Yeah. But it costs a lot to turn out a 250 plus the way that they want it. So they'll pay though. They'll pay. Sure. If you do it the right way, you're going to get paid. I mean, that's just the way that it works. But it's very important for LPs to understand the market in case the syndicator is not experienced. Then you have to understand the difference between a 50 unit and why you're buying a 50 unit and 200 units and who that end buyer is going to be. Because you made a great point before that 50 to 100 unit, those are local players. It's not just, Randy from down the block. It's going to be a local company that does this. But it's not, you don't have a list of 30 people looking for a 30 unit, because you're going to get those people who think they can handle it as a one-off. But that's not really who you want to sell to, because they're more likely to fail.
Maybe who ultimately buys it, right? But you're not going to have that person recognized ahead of time.
Yeah, right.
You're not going to know, all right, this person who's going to be getting into the game a couple of years from now is going to think that this is just their trophy asset that they're going to own.
Yeah. And also the more units, the less the actual quote market is really a participant. Most of the larger deals are done just through relationships and who people know. And you've already identified, as you said, 6-7 years in advance who your potential sellers are. So you're going to bring it to them first. It's not, you're not putting a 250 unit on Zillow and just saying like, hey, we're going to hold an open house. I think new investors maybe don't understand the dynamics between large scale commercial and just residential, what they see on their screens every day.
Yeah, I can honestly say I've never, I don't think we've ever acquired anything or even found anything close to like on a LoopNet or anything like that. I mean, we just haven't, right? Yeah. I mean, I'm not saying that there aren't.
It wouldn't get there. I mean, you would know about it before it got there. And if it gets to LoopNet, you've already passed usually.
For sure. Yeah. And if it gets to that point, we've looked at it probably long ago.
Right.
And discarded it long ago. But I will say for like the deals that we've closed in 24, for the most part, a lot of it has been, we were not the first or the second option. And we kind of just hung around the hoop, right? And that's how a lot of transactions, were closed, at least for 2024. And so I still think that trend will probably continue at least into the first part maybe of 25. But if we're, kind of crystal balling it, I don't really know what to expect in 25. I do know some of the metrics are showing that they're going to be a little bit better.
Yeah.
But some of them also aren't going to be better. So you just kind of have to weigh that. And there are a lot of people that have been sitting on the sidelines waiting for, a market crash or things of that nature. And it just
Better
doesn't
rates.
look like it's going to have occurred, right?
No, but I mean, long-time investors are always looking. It doesn't mean we're all buying every year, especially in large-scale multi. You kind of always vetting deals, but numbers aren't working. See if the sellers are going to come down, because there was a year to 2 years of sellers just being out of touch, not being able to sell on large-scale multifamily because they're trying to take back their debt.
And I would still say the bid-ask spread's still pretty wide.
I think so too.
But I also see it shrinking on both sides. So, we'll come to that equilibrium and more things will start trading. We're excited. Next month we'll be at NMHC, which is the big national multifamily housing conference. Yeah. And one of the things that we accomplish while we're there is we end up talking to all of our brokers for the state, just kind of, hey, here's what our expectations are for 25. We let them know where our buy box is, what we're looking for. It's a lot of conversations with our vendors and people like that. And we really just, you do out and you speed date on steroids because you just have a meeting after meeting, right?
Yeah.
And, we already did it with SSA in September of this year. And so it's the same kind of thing. But the guys that are out there talking that way, they're going to be finding the deals. We'll have deals brought to us a lot faster than trying to find something on LoopNet or dealing with one realtor or commercial broker, right? So we got a pretty big spider web that we put out there, but we're also very specific. These are the types of deals that we're looking for. Bring them to me in this buy box. And if it's slightly out of it, we'll still do the underwriting, but we're going to have to make adjustments for the returns expected that are outside of our buy box.
Yeah, I mean, especially important when somebody brings you a deal that doesn't match your buy boxes, whether or not they can explain why they're still bringing it to you. If they have that good reason, then it is worth putting it in. Maybe they're right. But, someone just sends it to you and it's not, you said we only want, 150 units and up, and they send you a 70 unit and don't say anything. It's like, well,
yeah, that's going to be real tough. That'll be real tough. But it was 146.
Right.
You sit there and you go, okay,
especially if they say, hey, there's room for 10 more units because they have a wasted gym or something, hey, here we go.
Or hey, this fits the income mold that you're looking for 150 units. It's maybe a better class asset or things of that nature. And you can still, get the returns you were expecting for your investors.
Yeah, if you look back on your history as someone who started in passive investing, what would you tell investors now who have the money, say they have 50,000 or more, and they're accredited so they can invest in a traditional syndication? Because I've been saying, I see that I think a lot of people are just going to go that way. If they have good income and maybe they're renting in a major city, it doesn't make sense to buy, and they don't want to buy a turnkey, in an area that they don't know. Just seems like a smart option if they've done the right vetting of the operator and they have references to make sure it makes sense. It's a pretty safe way to spend money.
Well, it's a greater control too. I mean, to me, and I mean, I don't think it's overly controversial to say you really have no control when you put your money in the stock market. And nobody's going to know who you are. Well,
you can't influence that at all. You just sit and look at the screen every day. You can only just decide when to sell or buy,
Absolutely. And if I go buy Apple stock, I'm not going to be able to call up there and say, I'd like to talk to the CEO of Apple.
Yeah. Can I get a PDF of breakdown on what your plan is for the next year? No, that's the annual conference.
It's a quick hang up. Or we don't care who you are. I mean, if you're Warren Buffett, that's different, right? Because you're putting billions of dollars into it. You own a chunk of the company. But even he would probably have to go, I need a meeting, right? And so it's just different, right? Because you have the ear of the person who's actually operating it, and you're getting more consistent updates associated with that asset.
And you can match the projections because the projections were there, and then you're going along to see if the projections match. Because when the projections don't match in the stock market, that was just like doing the weather. I don't know. Yeah. If you live in Florida, you just say it's going to rain every day because your chances are it's probably going to rain. I mean, that's not rocket science.
Yeah, we have an asset that I'm an LP in that we're probably going to exit in 25, and in talking with the lead on that deal, it's been hey, we've owned this thing for a very long time. He'll sit there like, yeah, but I'm paying out X in the form of a distribution. You're like, great, but if you have a return on investment, but you have a return on equity.
Yeah,
we have 400% in it. Your X that you're actually paying is, 1/4 of what it's actually worth to us. So, there's a lot of things when you're an LP is understanding the values that you're getting into, having the communication on an ongoing basis, and really getting your questions answered, right? And so you would hope that all of those things are happening on a consistent basis with the investment that you're putting into it, right? And so, and particularly when things aren't going exactly the way that you were hoping that they would go.
Yeah. I think when it gets off to not necessarily a bad start, but a different start, it's just important to get that transparency and knowing like, oh, okay, well, rents are going down in some areas, so have to kind of reposition when that's going to come. But if you look at the overall plan, you can kind of tell like we're fine. It's just I'm not getting
where you bought in the cycle, right? I mean, for the assets that I would say the assets that were bought in say 22, 21, I mean, really that was kind of the height of the cycle, right? And so it could be that your asset's not worth the value of what you paid for it a couple of years ago. Yeah. And that's, if you're telling your investors that, you go, okay, but here's how we're going to get out of it, or here's how I'm going to be able to enhance the value over this period of time to make sure that you're getting the most amount of money in that shortest amount of time.
Yeah.
Being able to communicate it that way.
Yeah, I mean, I think it's going to change a lot for a lot of people about what they're interested in, especially, of course, social media puts out a lot of information, which has created a lot of kind of hybrid syndicators who are brand new to it, where it looks flashy, but most people, I think, who are watching it don't understand the difference between a syndication and a fund and how that can affect, their performance and what they're investing to. So what would you tell a new investor who's interested in something more passive? How should they kind of try to figure out what's real out there about syndications and more passive investments?
Yeah, I mean, I would say educate yourself. I mean, that's literally the very first thing I would tell you to do. And so there's so much material out there. There's so many, podcasts and YouTubes and things like that. I mean, you could literally be doing this 24/7 for years.
Yeah.
But a lot of it too is to find that operator that you trust, find the GP that you trust, and then go in, like you're saying, do it that way. I mean, I would tell you, we put out content almost every day on social media. A lot of it is educational in nature, right? To help educate our investor base, really. But being part of our platform really gets people a lot more education, because we put out a newsletter every month that the content for that newsletter is really driven by the questions that our investors have. And so the theory behind that is, if somebody has a question,
a lot of other people do.
Other people do, right?
Yeah.
And so, and then having those resources available for them to be able to continue to educate themselves associated with it. We do investor events every few months, things of that nature, and we're constantly out in the market. So we belong to a lot of groups and masterminds and things of that nature, and so we're out and about. But there are a lot of those resources available to an LP investor that wants to get into things. And so, once you do that, it'll open your eyes. I tell people too, there's always another deal, right?
Yeah,
so
no rush.
You don't have to be like, oh my gosh, if I don't do this, I'm going to completely, miss out or whatever.
Yeah.
There's always another deal. And, that's just the nature of the industry. And so, but I would tell you, educate yourself. If you're going to invest in anything, do it in you first, so that you can make those wise decisions with your hard-earned dollars.
Yeah, love it. Awesome. Sam, is the best place for people to find out more information about you and Sunset Capital at sunset-capital.com.
That is the very best place to reach out to us. And we have all the social media stuff. And I say that, like an old guy with gray hairs. But that absolutely is the best way to find us, and then and to be able to join our platform. So.
Awesome. Well, I appreciate it. Glad to have this good conversation with you, talk syndications, talk a little Houston, Texas. It's been a pleasure.
Yeah, Jonathan, thanks so much for having me on, bud. Really appreciate it.
Yeah, my pleasure. That was Sam Morris. He's the founder and CEO of Sunset Capital. Remember, that's sunset-capital.com when you look on social. I'm Jonathan Green. We'll see you next episode. Thanks for sticking around to the end so you can get a preview of who's coming up on the next episode of Zen and the Art of Real Estate Investing. And next episode, you may be ready to get dirt rich. And that's the name of the book by Mark Podolsky, aka The Land Geek. So you know where we're going next week. It's land flipping. Mark's completed over 5,500 land deals, so he's got a lot to tell you. See you next episode.